Hello, this is Bryan Becker with Richardson Capital Management. Today is September 1st, 2021. I'm here with my colleague Dan Brown, our Director of Investment Research. We're going to walk through some of the highlights for the month of August 2021, as well as an outlook going ahead. To start off, Dan, equity markets, the S&P finished for a seventh consecutive month of positive returns. That's a very bullish indicator. Emerging markets, the Chinese Communist Party threw its weight around a little bit, produced some volatility in emerging markets. They didn't do quite as hot as the domestic markets did. Looking at bonds, we saw mixed results. Treasuries, interest rates rose, which means principal fell, so they had a slightly negative return. On the flip side, corporate bonds had the opposite, where they had a positive return overall. Looking at the economy and jobs, all green lights in that direction. All-time high in new jobs created, all-time high in record openings, jobs unfilled openings by employers. And then lastly, unemployment continues to decline off the spike from COVID. So that's where things are in a nutshell. Looking back at the month of August, the Fed Reserve Bank held their annual Jackson Hole Symposium. What can you tell us about that?
And we heard for the first time from Chairman Powell that they signaled that the Fed will probably start tapering their bond purchases sometime here later in the year. And it was very well communicated, so that's why the market really didn't react to it. In fact, the market reaction the day of the announcement was actually positive. So investors kind of breathed a sigh of relief that, okay, the Fed's going to start reducing the amount of their bond purchases probably sometime in the fourth quarter. And we heard from numerous Fed governors and presidents leading up to the Jackson Hole Symposium that they had signaled that they would like the Fed to start tapering the bond purchases. So again, very well communicated. Unlike the taper tantrum that we experienced back in 2013, where it probably wasn't communicated as well. Quite a bit of volatility around that time period. So for now, we've kind of sidestepped that volatility. And then just lastly on the Fed balance sheet, so from all the bond purchases they've been doing since March of last year when the onset of the COVID pandemic hit, so pretty sizable bond purchases. And again, we expect that to kind of taper off here in the near future. And we've heard a lot of Fed members signal that they would like the bond purchasing to end by mid 2022. And then the next logical thing that investors are paying attention to is, well, when is the Fed going to hike interest rates from a Fed funds of basically near zero? And we take that to be probably at least a year after the Fed ends their bond purchases. So it's at least a year out that the Fed would actually raise interest rates from the near zero level that we've been at for just over a year now.
And that's the word on interest rates. Dan, one thing we hear about a lot from talking to clients, we continue to have clients that are refinancing their mortgages, saving interest there, upgrading or buying second homes. Interest rates right now are very favorable to the housing market. That's what our clients are seeing. What's going on nationally?
We pay attention to housing as a data point because we think there's going to be some fairly long-term economic tailwinds from housing. Basically because we've been undersupplied in the housing market by about 5 million units as a fallout from the great financial crisis and the recession of 2008, 2009, when we underbuilt coming out of that recession, and we still haven't gotten back to a balanced market with equal demand and equal supply. And as you mentioned, interest rates, mortgage rates, historically low. And we see that millennials are the largest cohort now from a demographic profile, and they're starting to get involved in housing. So again, we think it'll be an economic tailwind for years to come.
So that's it on the markets, interest rates, housing, everything in the rearview mirror. What do we have to look forward to?
Yeah, we still have a positive outlook, Brian, mainly driven by the fact that there's a lot of negatives out there in the headlines mainly. But again, it's mainly headline risk and corporate earnings, record high, keep beating expectations, profit margins at an all-time high, and that's in the face of, rising inflation. So very good positive takeaways for us as we look at underlying earnings. And we're still going to have a supportive Fed for a while now with monetary supply, as we already talked about with the Fed taper. And fiscal supply, there's still going to be some aid coming there on the fiscal side. So overall, pretty positive outlook, although we're well overdue for a correction at some point in time. We haven't had one in almost a year now, so it wouldn't surprise us if we had a correction here in the near term. But again, overall, still very positive with our outlook.
Good. Well, that's our August update. I'm Bryan Becker. This is Dan Brown with Richardson Capital Management. Please like and subscribe to our videos, and we'll see you next month.